Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. With me at the microphone today, I have Stuart Sheary, and he's with the Institute of Financial Professionals Australia. We broadcast locally on Radio Northern Beaches and around Australia on the Community Radio Network. Stuart, welcome to the show for the first time.
That's right. Thanks for having me.
Wonderful. Now, ladies and gents, Stuart is a senior technical services specialist, and we're going to be talking about super and downsizers today. But Stuart, maybe a bit of an intro to our listeners and viewers who haven't seen your face before. Where have you come from and how'd you end up at IFPA?
Yeah, so prior to coming to IFPA, I was a senior technical services manager over at Insignia Financial, and there I was responsible for the education of financial advisors.
Oh, okay. So you education has been something that's been a big part of your corporate life then?
Yeah, explaining the technical concepts of super, tax, social security to financial advisors so that can provide a bit of strategic input to their clients.
Wonderful. And given the fact that the IFPA's clients are primarily tax agents, but I know that with PIPA, the wings have spread out a little bit more. Are you finding more financial planners are starting to join the association as well?
Yeah, we try and reach out to both tax agents and financial planners, and with a particular focus on superannuation.
Sure. I guess it's kind of fascinating. I've had recently a wonderful interview I did with a lady down in Melbourne and I'm not going to mention the company name now, but she was a chartered accountant and a financial planner, which is kind of a rare breed. But I think there should be more of them because I guess when I interact with an accountant, you cannot not have that discussion sooner or later. I think if you sit down with an accountant, you're looking at charts of accountant structures of your company or your personal finances. I sometimes scratch my head and go, how is that person not giving you personal advice? I don't know, but that I'll leave that one for the corporations law and the people that will worry about that. But look, today what we're going to be talking about is the downsizer contribution. Now, I have a very personal interest in this because I will, in the next sort of 12, 18 months, will most likely be selling my family home to actually downsize because I've got a very large Sydney home here and it's always been rather big. My kids, I'm not trying to kick them out, but I think it's about time that, they're going to be moving on sooner or later. But certainly I'm looking at very keenly this opportunity to start topping up super. And Natasha Panagis from IFPA was recently on the show because we were talking about strategies for topping up super. Now, we covered off a whole range of things, non-concessional contributions, concessional contributions, salary sacrificing, etc. And downsizing came up, but I said, no, we're not going to talk about that because Stuart is going to be coming on the show to talk about that. So first and foremost, can you explain the history of downsizing? Because it's not something that's been around since superannuation came in back in the 90s. So can you tell the audience a little bit about the history and why it's come in?
Yeah, sure. So back in 2017, housing affordability was a bit of a problem. What's changed?
And I was going to say, what's changed?
So the government of the time came up with an idea, which was to encourage, if you like, older empty nesters to downsize on their larger home to free up supply for growing families. And the incentive or carrot there was, if you sell your home, you will be able to make a contribution into super of up to $300,000. And the reason why this was a bit of a carrot is because we're talking about people being able to contribute more than what they would otherwise be able to. So, for example, if you're over the age of 75, you're not able to make a personal contribution with the exception of downsizer.
Similarly, so people over 75 can do this as well?
Absolutely. There's a lower age, there's a minimum age, but there's no upper age threshold. You can be 110, that's perfectly fine.
Okay, I didn't know that. I thought there was an upper limit as well because we're talking a lot about topping up super and the strategy sort of cut off at 75, and it seems to be once you hit 75, that's it. It's all over, Red Rover. But that's not the case.
Not the case with downsizer. So once you're 75, the only contributions that can be accepted by a super fund are generally super guarantee and downsizer super contribution. So if you're not working, downsize is your only opportunity. But keep in mind also, downsizer contributions are over and above the non-concessional contribution cap. So for example, if you're 60, you can still make your non-concessional contributions. And I'm sure Natasha spoke to you all about non-concessionals. And you're probably already aware that the maximum you can contribute in one financial year is 120, or utilizing 3-year bring forward rule, $360,000. But with downsizer, you can put an amount over and above that amount.
Cool. So look, one of the things that I looked at, and I'm looking away from the screen at the moment, but my briefing notes, there are 7 rules for downsizing. I think it's a really good opportunity in today's show to actually go through these rules. So rule number 1, the individual must be aged 55, but that's changed, hasn't it?
It was 65 and now it's 55. So when legislation first came in, you had to be 65 to make a downsizer. They've brought that down to age 55. So you can be relatively young and still make a downsizer super contribution. But
it did scale back to 60 at one stage and then 55?
That's correct. It originally 65, came down to 60, now 55.
Okay. So there must be a disposal of an eligible home. So when I see eligible, I immediately go, there are rules. So what are some of these rules that people need to be aware of? What is an eligible home?
Yeah, good point. So the first point I'd make is that you actually have to sell a home. So a vacant block of land will not qualify. Or similarly, if, say, a bushfire comes through and destroys your home, and then you say, look, I just want to get out of here. I'm a bit concerned about the bushfires in the area. I'm just going to sell the block. You're not going to be eligible because there's no dwelling or home on the property. Insofar as eligible home, it must be in Australia and cannot be a caravan or a houseboat or motorhome. So just keep those in mind.
Okay, so for the bushfire ravaged block, putting a caravan on there and then selling that ain't going to cut the mustard, is it?
That strategy won't work, no.
Okay, that's interesting. So, so we've got the situation, the eligibility there. So rule number 3, we're now talking about the home must be owned by the individual or their spouse. Now, I'm assuming we've always had joint names on our stuff. So it's either or both, one would assume. Is that correct?
Exactly right. So, for example, if the house is, say, in the husband's name entirely, that doesn't preclude the wife from making a downsizer contribution, even though she has no ownership in that property. There's a funny anomaly insofar as you could have a scenario where one member of a couple owns the home and is not eligible to make the contribution because they're too young, and the other member of a couple is 55, they don't own the home, and they can make the $300,000 downsizer super contribution.
Yeah, you'd probably scratch your head if you were giving advice at that point. You'd probably say maybe wait for the spouse to hit 55, because being able to make that, I mean, I've got to tell you, Stuart, from our perspective, my wife and I, we've worked on and off for a whole range of different reasons, and we're trying to get up to a reasonable level of super. This is a godsend, I have to tell you. For us, being able to sell the family home and be able to slam a decent chunk of change into super, plus the NCCs, the non-concessionals, that we'll be able to do hopefully between now and when I do turn 75. I'm kind of still fingers crossed, hopefully I can get to T-bar. So ladies and gents, if you're not aware of T-bar, it's the limit that you can get to, that you're allowed to hold in super. And this is a discussion I have with many people where they scratch their heads and they're still ambivalent about super. But Natasha and I at IFPA have had this discussion a lot, Stuart, and given you're just on board with IFPA, I guess from my perspective, super is still one of those incredible gems that we have in the investment landscape here in Australia. And if you think about a couple, and again, I assume that they're still together, all right? So let's say a couple, whether they're blended or otherwise, if they can both reach the limit, which I think it's at 1.9 million at the moment, or is it going up to 2 in July next year?
Highly likely. We don't know with certainty, but it's highly likely it'll be going up.
Let's round numbers. Let's say 2 each. A couple that can retire on 4 mil and then live off the earnings of that tax-free. I'm looking at people going, guys, I mean, you're not going to be Bill Gates or Jeff Bezos living the billionaire lifestyle. But when you think about the aims of super being able to retire comfortably, I mean, that to me is the definition of, hey, that's you're swimming. You're swimming very, very well, I reckon.
Absolutely. It's a very favorably taxed structure.
Yeah, and I guess one of the things that we keep on talking about is tinkering. Are they going to tinker? And I guess given your experience and the fact that you've been in education for financial planners before you arrived at IFPA, do you suspect that Downsizer is going to necessarily be touched, or is it a popular enough piece of legislation that, given that we've got an election cycle coming up soon, do you anticipate or even see rumblings that that there may be some adjusting or tweaking to this kind of policy?
Well, interesting you say that. If anything, they've become more generous in their policy setting insofar as downsizer. As you alluded to before, the age has come down from 65 down to 55.
Mm-hmm.
So that wouldn't appear to be on the horizon to tighten the screws, if you like. Keep in mind, though, the $300,000 limit is not indexed. So if anything, over time, maybe it'd be less important as inflation erodes the value of that contribution.
I guess in the yearly briefings or the 6-monthly briefings that IFPA does when it interacts with Canberra, I'm surprised, or maybe it may be something that's on the to-do list to maybe say to Minister Jones or whoever's going to be in the chair after the next Fed election, that maybe that is a consideration, that indexation of that contribution should be considered, because I think it's incredibly valuable. But it's, as you rightly pointed out, Stuart, at the beginning of the show, it serves two purposes. Yes, it gives older people an opportunity to top up their super, but I think more importantly is it starts the idea of freeing up stock of these very, very big homes where people are rattling around in them. And it's like, guys, and I mean, I want to move out of this big house because I'm sick of maintaining it. So I don't want to do lawns anymore. I've had enough. But the idea that you've got an older couple rattling around in a 3-4 bedroom house with a formal dining, I'm just sitting there going, come on, guys, let's get real. We don't need to have all of this. And so I guess, it's one of those interesting things. But look, we're just about at halftime here on Dollars Making Sense. You're here with Stuart from IFPA, and he's a technical product specialist, Stuart Sheary, and we are going to take a short break, and we'll be back in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform, or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson. I'm really pleased to have at the microphone this week, for the first time, Stuart Sheary from the Institute of Financial Professionals Australia. And today we are talking about downsizer contributions to be able to top up your super. Now, Stuart, before we went to the break, we were talking about the eligibility and about whether a house is, a caravan, or is it a block of land, or, what's the situation. But we're going to move on to Rule 3 now. The home must be owned by the individual or their spouse for at least 10 years. So a bit more explanation about that rule.
Yeah, absolutely. You can't buy a home today and sell it in a year's time and make a downsizer contribution. You need to have owned it for at least 10 years, and that ownership period begins at settlement to acquire the property and ends at settlement to dispose or sell that property. So the idea is it's a longer term home, and in the context of encouraging empty nesters to downsize, it makes sense.
Yeah, okay, that's fairly straightforward. I don't think you can really gild the lily on that one too much, can you?
One point I would make, though, is that we're looking at the combined ownership period. So, for example, if the where we're talking about marital splits, for example, the ownership period of one member of a couple can count towards the ownership period of another. So, if the home is owned by one person, there's a family law split, the other member of the couple receives that property, and then they sell it a year later, they can potentially satisfy that 10-year rule if the other member of a couple had held it for 10 years.
Okay. Now that's important to know. Okay, let's move on. Rule 4. The disposal of the home must qualify for at least a part main residence exception. What's that mean?
Yeah, so I'm sure your listeners are aware with the main residence exemption, arguably the best CGT concession out there, you don't pay capital gains tax on the sale of your home, okay? But you may not be eligible for the full main residence exemption. For example, you may not have lived in the property for the entire period of ownership. Perhaps you've rented it out, perhaps you've treated it as your a holiday home. What the downsizer legislation says is you must be eligible for at least a part main residence exemption, meaning it was your main residence for a period of time.
For a period of time. Is there a minimum time of that 10 years, or just you own it for 10 years, but you had to have said it was yours for at least a period of time?
Good point. No, there's no minimum period of time. You just have to tick that box. So it could be 6 months.
That's interesting. Okay. I'm surprised the commissioner wouldn't potentially look and frown upon maybe, a 2-week period, or, I'm curious, put it that way. I don't know. It'd be interesting to be tested, I guess. Okay, moving on. Rule 5, the contribution must be made within 90 days of disposal of ownership. That sounds pretty straightforward.
It is. I just make the point there. So your ownership ends at settlement. So from then, for 90 days, you've got that window period to make the contribution. The ATO can be flexible. So if you give the ATO a call before that 90-day window has passed and you have an excuse, they can actually extend that 90-day window period. The ATO are not very generous when it comes to asking for an extension simply to satisfy the age requirement. So for example, if you're 53 today and you say, hey, ATO, please give me a 2-year extension on this otherwise 90-day window, they're not going to give you an extension on that.
But what kind of reasons would you ask for an extension? Is it some sort of, is the delay of the money landing or something like that?
No, keep in mind, you haven't sold it until you settlement. So it could be ill health. We are talking about older people. Alternatively, I have seen a scenario where someone successfully got an extension because they weren't too sure how much of the money they were going to use on their next property. So they said, ATO, I would like to put in what's left over, but I don't know how much my next home's going to be.
So they hadn't concluded the transaction to where they were going to live next time.
Exactly. So that was in one scenario. Whether the ATO are always generous there, I'm not sure.
Okay, well, that makes sense, I guess. And again, I always say to people, don't think of the ATO as ogres. Give them a call. They're human beings at the end of the line. I have found them at times to be incredibly nice. I've had instances where I've had fairly thorny issues to deal with them, and I've found them always to be very, very good. So, Rule 6, downsizer contribution must not exceed the lesser of $3,000 or proceeds.
300,000.
Yeah, it's just 300K, isn't it?
I think the easiest way to explain this rule is to look at a couple of examples. So, for example, we sell the home for $1 million, then both member of a couple can put in $300,000 each, a total of $600,000. If the home was only worth $500,000 and they only received $500,000 from the disposal, then the most they could put in would be $250,000 each, or maybe one member of a couple might put in $300,000 and the other put in $200,000. But the total combined can't exceed the capital proceeds from the sale.
All right, that makes a lot of sense. I'm just curious because we've had a fair bit of discussion, and I've just, for example, just recently finished my annual return for my own self-managed fund. We're now starting to tilt contributions so that my wife's total starts coming up because there's been this inequity because she was at home raising the kids while I was off working. That's not unusual. So with the downsizer, can you make more for one spouse than the other?
Yes, subject to a limit of $300,000. So
within the parameters.
Within the parameters. So, but one member of a couple can't put in 400 and the other 200, where it's still an individual limit of $300,000.
But if, for example, they were below those limits and there was a defined strategy to try and bolster, the spouse's total, they could do so and they'd be an uneven and there wouldn't be an issue with that.
No, I mean, one member of a couple might just put in 100,000, the other one might put in $300,000.
Okay, cool. This one's a bit of a bummer. Have not previously made a downsizer contribution for another home. So it's a one shot then, is that right?
One shot in relation to a property. So if you sell your home and you want to make a downsizer on that home, that's it. But if we're talking about couples, maybe one member of a couple might say, you know what, I'm not going to use my downsizer opportunity. I'm going to use it on my next home when I'm a bit older and I can't make non-concessional contributions anymore. I'll save my downsizer for later. So yes, an individual can only make a downsizer on one property.
Okay, because my thinking is, given the fact that we're going to be living a lot longer and the fact that this doesn't have an upper limit, if, for example, you did it in your 60s, you then bought your next place and held that for 10 years and then find your super balance going down a bit much, if you downsized again, you could then potentially chuck more money into super in that tax-free fresh vehicle. But that's not the case then, is it?
Great point. Yeah. So in that scenario, once you've sold the home and you've made a downsizer, you can't do it again. But again, perhaps strategically, the spouse might want to hold off on using that opportunity, but they can do it on the next property.
Cool. I guess it's a combination of that and NCC, if that's your stratagem, because I guess certainly that's what, in my own case, that's what I'm looking at. So sure. I guess when you hear the term downsizer, the whole idea is that, for example, in my own circumstance, I've got a pretty big home. I don't want something this big when I move next time. But that's a bit of a myth, isn't it? You don't actually have to downsize, do you?
You don't. You don't even have to buy another property. You can upsize, downsize, or decide just to keep the proceeds and rent. There is no requirement.
I didn't know that.
Yeah, you don't actually have to. What you do with the money afterwards is entirely up to you. You just have to dispose or sell your home. So you could have a scenario where someone sold their home and buys another home and still makes another home worth more and larger, and still makes a downsizer contribution using cash in the bank. So you don't need to find a nexus, if you like, between the actual proceeds and the contribution. You might actually have cash in the bank, which you use to make that downsizer contribution.
That's interesting. That gives a lot of flexibility then, doesn't it? When you think about the prospect of being able to lump a big chunk into super, and then you're free to go wherever you like. You're not being forced into. And I guess when they wrote the legislation, I always I joke about this. It's an old Aaron Sorkin thing about the two things you don't want to watch made: sausages and laws. And so, thankfully, when they wrote this law down, they went, downsizer is the name, the colloquial name, but if we were trying to enforce that, how do you write it up? I mean, I think maybe common sense prevailed once in a while when they're drawing up legislation, and they went, no, maybe we'll just let that one go through to the keeper. And so you think about that, it actually makes a lot of sense, but sometimes you look at government, it doesn't always happen that way, but it's nice to see that it has in this instance.
Rules are relatively simple in that context, yeah.
Yeah, exactly. Well, simplicity in legislation is kind of nice sometimes, because again, one of the things that we're constantly talking about is the fiddling that they're doing right now in the 3 million and the taxing of non-realized gains. I'm sitting there going, no, what are you doing? Anyway, let's keep moving on, because we're covering over 3 of the common myths. So another myth is you must live in the property at the time of disposal. So this goes back to what you were saying before. It could be a rental, could be a holiday home. So you don't actually have to be living in it. Is that right?
Yes. Well, we have to come back to the element that it must be eligible for at least a part main residence exemption. So yes, it may be an investment property at the time of selling it, or it may be a holiday home at the time of selling it, but it must be in your home at some point in time.
Gotcha.
So you must be eligible for a part main residence exemption.
This last one's a little bit of a funny one. Proceeds. So the myth is, the 3 common myths: proceeds must come directly from the sale. What do you mean by that?
Yeah, so just as we're talking about, it's quite possible that you upsize and the proceeds, the actual proceeds from the sale of the home actually go towards buying another home, and instead we use perhaps money sitting in the bank to make that contribution into super. So we might have an SMSF, we might have some BHP shares, and we might use our capacity. We might transfer those listed shares into the super fund as part of downsizer.
Okay, so you do the in specie contribution, but I mean, at the end of the day, you're just shuffling money from the same bucket. At the end of the day, it still ends up where it's got to end up.
Exactly, but some people get a little bit confused, thinking that the money that they received from the purchaser has to be the exact money that goes into super, and that's not the case.
Right. So some opportunities and traps. I like these. These are sort of the pros and cons. Now, we've talked about recontribution strategies before, and I don't want to go into too much because that's an entire show of its own accord. And so, ladies and gents, if you're not sure what recontribution strategy is, please go to the IFPA website or Money Smart or talk to your financial planner. If that's something you need to consider, we're not going to go into it today. But the age pension entitlements. Now, we get Services Australia come on our show quite a lot, and they're always keen to let people know, be careful about your age pension entitlements. So when you're doing a downsizer contribution, it could have impact, couldn't it?
Yes, and it could have a positive impact in some scenarios. So where we have a couple, we're looking at the combined income and assets of the couple, even though one of the members of the couple might be age pension age and the other member of a couple might be younger. And so that younger member may not be eligible for age pension. Thing with super is it's not assessed by Centrelink until you attain age pension age. So if that younger member of a couple puts money into super, it's not going to impact the older member of a couple's age pension.
Okay, so something to make sure you obviously chat to people in the know in that regard. Now, subdividing as well. This makes a bit of common sense when I think about it, but if you are subdividing a property, if you want to take advantage of the downsizer, you need to do that before you do the subdivision. That would make sense though, wouldn't it?
Yeah. One question that often arises is, I've subdivided my property, that half hectare out the back that doesn't have a dwelling, can that be, if I sell that, can I make a downsizer contribution? And for two reasons: no, as we mentioned, there must be a dwelling on the block, and secondly, the disposal must qualify for at least a part main residence exemption. So if you are subdividing, make sure that there is a dwelling on the block and it is eligible for at least a part main residence exemption.
You do it before the subdivision, I guess. That's the other.
Oh, yes, absolutely. Yeah. So if you were to sell the entire block with your home on it, yeah, you may well be eligible.
Okay, and last one, preservation. It's important to remember that the contributions such as downsizer are preserved until the individual satisfies condition of release. I mean, that goes without saying, but the difficulty is there's so many illegal releases. We need to say it. So it's one of those things, just because you plop the money into super, guys, that doesn't mean you can't touch the money. You can touch the money. It's still applied. The conditions of release have to apply, don't they?
That's right. And when the legislation first came in, as you mentioned, it was originally 65. So there was no problem with accessing the money. Once you turn 65, you've got full access to your money. Now that the age has been brought down, you can make the downsizer contribution at 55, but you can't necessarily take the money out.
Stuart, we're just about out of time. Absolute pleasure. We always run out of time so quickly. Stuart Sheary from the Institute of Financial Professionals Australia. Thanks for being on Dollars and Making Sense and talking to us about Downsizer today.
Thanks, Ray.